Alrighty. So tonight, personal finance, investing fundamentals. So this is probably more the bread and butter kind of stuff that you guys were, at least when I think of personal finance, we've talked about insurance, healthcare, all that kind of stuff. It's important and it's necessary, and it can be very confusing. But some of it's kind of dry, and some of it you have varied levels of experience. But investing, I enjoy investment. I don't when I say I don't understand investing, I do understand it, but the market moves right now are pretty perplexing for anybody. So, unfortunately, the stock market these days has gotten to be a game where there's a lot of professionals who already had the information before it makes it out to the news. So, if you're watching today, they stopped the Fed pumping. The Federal Reserve Bank, basically printing money to kind of inflate the stock market. So you would have thought that would have meant the market would dive, but no, it went up. So anyway, it's a course in itself. It's probably too complex for most folks. Most folks are probably better off not getting involved in market timing and doing that kind of stuff. But you do want to probably still want to be involved in the stock market. And I know a lot of people are risk adverse and not excited about that, but it's just the nature of the world we live in. If you're going to be working for a large company, corporation, or even you could be an instructor here, and you're still going to be in mutual funds, and so you're going to be in the market, and hopefully when I say in the market, you're going to be ordering in a broader base of stocks, and so not quite as volatile. But overall, you really don't want to miss out on that potential. Other than real estate, I do, and I think a lot of people do like real estate because again, it holds some benefits. But stock is and mutual funds are just collections of stock. Anyway, getting way ahead of ourselves. Right now, we're just going to be talking about the basic fundamentals and why you should invest and things like that. Safety, risk, income, growth, liquidity, asset allocation, personal investments, and anyway, how to get that information. So this doesn't need to be that complex, and really, you don't want to obsess over. You really don't want to obsess over anything, but you really don't want to be poor either, or you will be obsessing over the fact that you're poor. So you got to know a little bit about investing, and you need to know it earlier in life rather than later. Most people will be what they call financially literate at some point in their life, but if you learn it when you're in your 60s, time value of money is a problem. So you need to learn it early on, make some good investments, and sit back and watch it all happen. But there's a huge difference as you'll learn in between investing when you just have a short amount of time and a long time. So anyway, we'll get moving here. Investment goals. How much do you need for your goals? How much money? How to obtain the money? How long will it take? And how much risk are you willing to assume? So again, a kind of a no-brainer is people think, oh, I'm going to avoid risk. I'm going to keep my money in cash or even gold for that matter. And I'm not going to argue about those kind of strategies. But anyway, just putting your money in the bank, you may think that there's no risk, but that is certain risk. That money will be degraded over time. And there's also an opportunity risk. It's what you could do with reasonable investments and make that money work for you rather than having it eaten away by inflation. So you're going to have to set your own goals, but there are some guidelines, and actually it's quite easy. The whole notion, you'll see this even on the exams, and you'll see it, and just, maybe it's the financial talk shows or whatever, but they'll talk about paying yourself first, and that's the whole key. You do not go embark on a savings program and your goal is to, okay, I'm going to take care of all the bills and all the other money, buying this and buying that and going out to dinner, and then whatever's left over, I'm going to invest that. Well, that whatever's left over, usually it's not a consistent source of of investment money. So what you need to do is you need to just say, look, I've got another bill each month. I'm going to say maybe 5% of my income. And maybe if you're just starting out right now, you're scraping and you need every dollar, and you got kids and you don't want to you don't want to have them not have the things that they should have that maybe you can afford. But there's going to come a point in time, and certainly hopefully sooner rather than later, where you can afford to put away 5%. And when you do set away that 5%, the best strategy is just to consider that as a bill. And you can actually do that through maybe a mutual fund company, or if it's real estate, that'll kind of take care of itself through a loan if you're doing it that way. But tenants more involved. But anyway, if you are, say you choose a mutual fund company that you want to start a investment program with, they usually have very low requirements in terms of like a monthly amount, maybe $25 a month, because they know that if you're a recurring investor, that money's going to grow, and your loyalty with that company is going to grow as well. So, companies really market towards people. This is a theory of marketing where they market towards people that are young, because you're not quite set in your ways. A lot of the older folks have money, but trying to get them away from that is difficult. And you see it in everything in terms of consumer preferences and other things. So, anyway, mutual fund companies are pretty aggressive and pretty enticing in terms of what they will offer you to start up an investment program with them. Now, I'm not saying salesman type stuff, and I'm not advising anybody to go down that route. What you do is use some of the resources that we'll discuss tonight. You identify a few companies. You ask for a prospectus, which is just a kind of a description, but it's also a legal requirement before you can invest with that company. And then you set it up. So anyway, again, we're getting way ahead of ourselves. I'll try and get back to the program here. So sacrifice is necessary. So that's it. I mean, it's all trade-offs. You can have a $5 coffee every day, or you can have $150 at the end of the month to invest. Now, I'm not saying you need to go without, but you can maybe find a cheaper alternative, or a different alternative to going out to lunch every day and dropping $20, $30, whatever. So anyway, hopefully there'll come a time where you can do both, but initially, there's going to be some trade-offs. So economic circumstances or your investment goals reasonable. The deal is that people are living longer and longer, and so the amount of money you require, that nest egg, can be a lot of money, like $1 million. But let's say you are fortunate enough to get $1 million away in a nest egg. You can do a lot with that, and it's not, $1 million sounds like a lot of money, but if you start early and you start regular savings, you can attain that. And then let's say 8% return on investment is not unreasonable. 8% on $1 million is $80,000 a year. You could do all right on that. I mean, especially at your later stages in life, when hopefully your house is paid off, kids are in school, done with school, all the rest of that. So anyway, and I'm not discounting the fact of inflation. $80,000 then may not buy a whole lot more, but your income, your nest egg will continue to grow. But at some point, you got to come up with some goals and set it aside. And the main way to get this done, to get this started, is to pick a certain percentage and consider it a bill and start socking it away. So again, 5% is probably pretty reasonable, maybe up to 10 at a later point. But and then if there is a matching policy with the company you work with or will work with, that is a no-brainer. You will do whatever it takes to attain that matching amount, because that's free money. That's actually should be considered an increase in your salary. So usually that's not that high, 3, 5%, whatever it is. You want to make sure you hit that. And what in a matching program they would say give you another 5%. So that is free money that you do not want to leave on the table. So anyway, financial checkup, doing a budget. Do you spend more than you make? pay off high interest credit cards, an emergency fund, 3 to 9 months of living expenses, and then have access to cash for emergencies. So, again, this is one of the advantages of having credit cards that are completely paid off. You're killing two birds with one stone. You aren't paying those high fees, and then you also have a bit of a cushion. Now, you don't want to get a cash advance on a credit card. There's, I don't know what kind of emergency you're dealing with that requires cash. Usually, most folks will take credit card, medical, or legal, or whatever your expenses are. So, but having an emergency fund around is good. Having an empty credit card in addition to that can supplement that emergency fund is better. But there's very few cases that deal with a lot of cash. They deal with a lot of money, but usually can go on a credit card or some sort of loan. Next things, managing financial crisis. So, this should be probably better labeled, preventing a financial crisis. Have the emergency fund, have the ability. I don't like a lot of fixed payments. I like to, especially for recreational items, something like a four-wheeler or a boat or something like that. The closer you can get to paying cash for that, rather than be locked into these monthly payments that are going to continue into the future. Again, I tend to want a lot of things though, and some people just want one really nice thing. So I can understand when you want to buy brand new in that case, but just keep in mind what you're doing, and always think worst case, if my job goes by the wayside tomorrow, just how deep a hole am I going to be in, and can I sell whatever I bought? What's the market value of what I've got? Something is only worth what somebody's willing to pay for it. So keep that in mind. Money you need to start the investment program. So this kind of takes care of itself in my mind. Once you, and believe me, if you haven't done any investing yet, if you pick some amount, whether it be $25 a month, if that's all you can scrape together, or 5%, you're going to see that money start to accumulate, and then at the end of the year, you're going to get a statement on that. You're going to see how you made some interest, and then a few years down the road, and for me, once you start saving, it becomes easier to save, because you realize, one, you could do without that extra coffee or coffee every single day, or not that I'm scrounging on coffee, but there's different means to get coffee rather than going to Starbucks. But anyway, no personal vendetta there. But everything's got trade-offs. But you're going to see that money start to accumulate, and the greed factor is going to kind of roll in, and you're going to go, wow, I wonder if I can put in 15%, because I like this nest egg kind of massing here, and I think you'll need to maybe put the brakes on even at some point to realize that I can eat ramen in the dark, but the wife and the kids are about to disown me because I'm keeping the house cold, because I'm doing all these things to be very frugal to put more money in the savings. So you got to find a balance, and anyway, pick a percentage, and the percentage will probably stay fairly uniform, and you'll be fine. Safety and risk. When somebody says, oh, I was getting 20% interest and I lost all my money, well, how are you getting 20% interest? Risk is reward and risk. They go hand in hand. If somebody's paying you 20%, it's a competitive world out there. The only reason they're paying you 20% is because there's a lot of risk in there. Okay. Same to be said though, if you're only getting no interest or just a little bit, well, there's inherent risk in that too, because inflation's eating you alive. So what you need to do is you need to come up with a balance, and it also has to fit sort of your appetite for risk, so that you can sleep at night and the rest of that. And especially in a relationship, a marriage, whatever, you need to make sure that it's copacetic there, in terms of a very high risk individual where the other member is stressed out about it. That's not a good idea. In that sort of case, what I would do, and is maybe do this 5% into the reasonable savings plan. In that other method of, hey, any money that's left over at the end of the month, that's going to be more money to invest, and perhaps that money could go in the riskier stuff like individual stocks or other investment vehicles that the other person feels are too scary. So anyway, there's different ways to do it, different strategies, but most of your money should be in more conservative. Well, I don't want to say conservative because you're at a time in your life when you can handle a fair amount of risk when you're young, and I'm making that assumption. There's all these mutual funds and other investments that are sort of tailored to when people get up close to retirement, they get a much more conservative investments because if the market takes a huge dive, they don't have a chance to recoup, But if you're young, the market takes a huge dive, well, it'll come back before you're ever going to spend that money. So, and that's sort of what they're showing here on this pyramid, speculative stocks, options, commodities, high risk investments. So, that's fun money, but that is a lot like gambling. And for me, it's more fun than gambling because if you go to Las Vegas, you will lose. I mean, it's pretty much a certainty. With stocks, there's still a small chance that you could make some money, but you're fooling yourself. That's not necessarily investment. That's speculation. Growth stocks, growth-oriented stuff, rental property. For most people who would be taking this course, that's really where you ought to be because that's where you're going to make your money. And categorically, most of you aren't that close to retirement, so you can recover if things go poorly. Now, you don't want to get involved in just individual stocks up in that top pyramid because they can go all the way to nothing. Most other stocks will just sort of be volatile and move around, but grow in the long run. Safety and income, U.S. securities, mutual funds. That's kind of where I park my money when I'm not in the growth sector. But again, it's not paying much more than those CDs and money market funds down on the bottom. So those things, that yellow category is not keeping up with inflation. So that's a transitional state. And that's why in the emergency fund, I'm not saying not to have an emergency fund, but more isn't necessarily better. If you've got wads of cash in some emergency fund, that's not a good idea because you're not taking advantage. You're not having that money work for you like it should. Risk tolerance. So again, beating a dead horse here. Calculating the rate of return. You'll do that in the homework. It's not that tough. But you just look at the, how much did I pay for it? How much did it make me? And then how much did I sell it for? So when you're looking at stocks, mutual funds, there's two ways to make money. One is the capital gain. So let's say, I've bought old Corvettes and Dodge Vipers and stuff like that. So let's say I bought this one, I paid like 11 grand for it and sold it for 16. So my capital gain was the what was that, $5,000. But it wasn't paying any interest. It wasn't paying any income. Most stocks that pay dividends, and not all stocks pay dividends, that would be a regular income that would be coming in the form of a dividend. Categorically, growth stocks and most of the stocks that you want to be involved in, again, assuming you're a fairly young person, will not pay dividends because they're growing companies and they're reinvesting in the company. So it may just be strictly a capital gains kind of stock appreciation type play rather than a dividend income thing. Anyway, we'll talk more about that. This isn't really on stocks, solely tonight. So we'll have plenty of time to discuss that in future lectures. Inflation risk. It's not a risk. It's a certainty. Inflation will eat up your money. So, 6% bond, rates go up to 8%, your bond price fails. Why? Because the market's competitive. The reason, again, getting back to this 20% interest, the reason why somebody's paying you 20% interest in investment is because nobody's buying it at 18%. If they can only pay, if they could get people to buy this investment at 15%, they would. But for some reason, usually due to the risk, they're having to offer 20%. So there's a return there. Now, bonds are unique. I'm not a big bond person, and not all bonds, there are certain categories where they're rated. Well, again, we'll discuss this later. There's junk bonds that are super speculative. Many bonds, though, are very conservative. But the problem with bonds is as interest rates go up, the value of the bond goes down. Okay? So where are interest rates right now? Really low. So what can happen to bonds? They've only got one way to go, really, and that's down. So to be holding bonds right now, long-term bonds, they're not a very attractive investment. So we'll talk more about that right now, but having a lot of bonds in your portfolio when interest rates are low is not good. Business failure risk, businesses go out of business, and that's why individual stocks, if you're maybe certainly a less risk approach would be to invest in a sector rather than an individual company. Let's say you're going to make a speculative move, and some people did. In fact, a student made a lot of money on Ford when all those stocks tanked. That's a pretty speculative move. If you want to broaden out your risk and have a little less exposure, you would invest in all of the automotive industry, with the understanding that if GM goes out of business, well, people are still going to need cars. So as a sector, the sector's still going to stay up because people are going to have to buy from Chrysler and Ford and the other manufacturers. So as a sector, the sales may be relatively close to what they were. But if you own GM totally, that's not a good deal. Car investments, at least U.S. car makers, I would stay away from that sector altogether until things shake out. Besides, most of them now are, they all foreign, except for GM that's owned by the government. So, yeah, not a good sector to use as an example. Market risk. So prices fluctuate behaviors of investors, but also the government. Okay, the Fed buying and being involved in the markets is huge and causes a lot of the fluctuations right now. Investment risk, global investment risk. Yeah, this is an interesting time, especially with oil prices right now. And the U.S. is actually pretty well poised because the U.S. can produce oil at a lower per barrel rate than these other countries and still make money. Places like Russia and Saudi are starting to get beyond or below the price that they can make money. I'm sure I've got some oil people out there who could school me on a few things, but in general, the low oil prices are hurting the other countries much worse than they're hurting the U.S. right now. Safest investments, predictable income, savings account, savings bonds, treasury bills. I don't like the term safest. I mean, you are guaranteed. I mean, in times of turmoil, maybe you want to do that, but I don't know. I still couldn't make the case for that. I look at those as more transitional type things. If I was scared of the market, stock market, equities, I'd be involved in real estate. But you got to do something. Investment income, higher potential incomes, municipal bonds, corporate bonds, preferred stocks, income, common stocks, mutual funds, real estate, realty, rental property. Yeah. Don't be confused. Preferred stocks are not, those are the better ones. No, it has to do with how they treat dividends. And they're not, again, common stocks is not a good name either, but preferred over common stock, it just means how the dividend is parceled out. And preferred stocks will get a dividend before the common stocks if they don't have enough money for both. The problem is when companies are doing poorly, they usually don't have enough dividend to pay either. So, being 45th in line versus 44th in line is not a huge distinction. So I've never owned any preferred stocks, nor do I deal with income stocks that pay a dividend, because I'm usually dealing with growth stocks that will appreciate. So again, you'll learn more about this as we go. Well, in fact, right now we'll talk about it. Growth will increase in value. So that's the play. It's not a dividend thing. You're not relying on this annual dividend that's going to come through. They're reinvesting in the company to make it a bigger company. Mutual funds are just the collections. Mutual funds can be, traditionally, they're thought of as a collection of stocks, but they can also be a collection of bonds. They can be some real estate type things. So it's just a investment vehicle where investments are pooled together to sort of, it does change the risk characteristics. Rather than you be invested in one company and that one company fails, you're wiped out. In a mutual fund, they'd all have to fail, which is much less likely because when one fails, somebody else is going to take up the slack in terms of the market and the business, and it's a better deal. Investment liquidity. So you do have to worry about how quickly you can get at your money if it's part of your, well, it shouldn't be part of your emergency plan, but if you need that money, can you get at it? And that being able to get it is called liquidity. They'll make the statements several times in here that real estate is not a very liquid investment, which is true. It takes a while. You got to find a buyer, and then you got to have the deal finish, and that can be pretty involved. And the problem with real estate is, you as a buyer can pretty much walk away at any point. Either the buyer or the seller can usually weasel out because the contracts are written as such. They don't want people involved in real estate transactions who don't want to be part of it. So anyway, real estate deals can fall apart. So not a very liquid investment. If you need the money tomorrow, you can sell stock and get it. Generally in 3 days it'll settle. But in real estate, that's not going to happen. Other things, asset allocation, investment alternatives. So this asset allocation, it comes to it's more of a factor of age, like I was saying, where young folks in growth stocks, as you get older, you're going to get into more conservative investments, and then when you're retired, you're going to be in stocks that will pay a dividend because now you're relying on that as a source of income. So it's one strategy, but there's so many variables. I still have most of my stuff in growth stocks because I'm continuing to work. So I will work. I'm not retirement age, and even when I get to retirement age, I'm more concerned about what I'm leaving for my kids rather than living expenses. I don't anticipate retiring for reals anytime. So anyway, we will see. Time factor: longer invested, better your opportunity for increasing returns. So again, and the more aggressive investments you can be in, because you have time to go through those ups and downs. The only time you lose money, in the stock market or real estate is when you sell at the bottom. Things do go back up, whether they be real estate, stock market, whatever in general. So, but if you get yourself in a bind, or you got yourself into too much risk, then you could, emotionally, mentally handle and panic and sell. You're going to get clobbered. But ride it out, you'll be fine. When people say, "Oh, I lost whatever amount of money in the stock market," did you sell today? If you didn't sell, you didn't lose anything. So, your age, type, and style of your investment should change with your age. So, again, that's part of an asset allocation strategy that we discussed a little bit. Stock and equity financing. How does it work? Why do companies do it? A bank, would loan money to a company if they wanted it, but banks usually, or companies don't want to be beholden to a bank, and they don't want to pay, exorbitant rates. They'll usually, as a corporation, they'll sell shares of their stock. And so you, as a stockholder, become a part owner. And so it's a way of getting financing. So, but the corporation has no legal obligation to pay dividends. So, two basic types, and again, they'll get in this common stock and preferred stock. Not a huge issue for most of us. It's just, it has to do with how dividends are paid. I'm sorry, did they not explain that? Okay, well, we will talk about that, because there's actually going to be another chapter on stocks. Believe me, I have reviewed these slides, but it's just confusing in terms of what comes up in which week. But common stocks are not necessarily worse than preferred stocks. And a lot of companies, they only have common stocks. Most stock out there is just common stock, and it doesn't mean that it's bad stock. And preferred stock, it doesn't really give you any guarantee other than if the company can't pay dividends to everybody, well, then the people with the preferred stock are going to get a dividend before the people with the common stock. But do you really want to be involved in a company that's not able to pay dividends? So I'd probably be selling that company and moving on to somebody else. Corporate and government bonds. So a bond is a loan. So, you know, again, there's bond holders, and those are the people who hold the money. Banks are involved in terms of orchestrating this. You normally, don't buy bonds directly from the company. There's an intermediary bank in there that takes care of that. But at a certain point, 1 to 30 years, that bond will hit maturity and that money comes back to you. So now the thing is, you don't have to keep that thing, like it says, until maturity or sell it to another investor. But the ability to sell that bond at the price you paid for it depends on what the interest rate is. So if you bought it during a low interest rate, let's say you bought a bond that's paying, a couple percent, and now interest rates go up, and so the new bonds they're selling are paying 4%. Well, your bond that only pays 2%, nobody wants it. They can buy a better bond right now. So they're going to buy the one from you at a discount rate. So, let's just say it's a $30,000 bond. They may say, nah, that thing only pays 2%. I'm only going to give you $25,000